Hi, I'm Giuseppe Incarnato, Chairman and CEO IGI Investimenti Group. Welcome to Private Equity Lesson 5864. The exit phase is a fundamental step for the private equity investor, as only through it does the monetization of the creation of value implemented during the investment period take place. Through divestment, the creation of value becomes from theoretical to effective, transforming the portfolio valuation into a price and consequently into a yield obtained on the market. For this reason, from the first analysis of the potential investment, private equity operators question themselves in advance about the exit possibilities and the most likely categories of potential acquirers at the time of divestment, despite being very distant in time. During the investment cycle, the prospect of exit cannot be neglected, in particular when the company must evaluate a transformational acquisition that could positively or negatively affect the success or the exit. Think of how profitable it is, for the purposes of a subsequent valorization, to have increased the scale of the company and its degree of internationalization through a build-up strategy and have placed it in a range of higher multiples. For the purpose of maximizing the capital gain inherent in the shareholding, the critical factors in the exit phase are essentially three: the choice of the time window to implement the divestment, which depends both on the performance of the company in the portfolio and on the conditions of the M&A and capital markets. Identification of the category of potential buyers, strategic and financial or public equity market. This choice will influence the adoption of the divestment process, which may result in an M&A or IPO path. The decision on the sales strategy to best enhance the outgoing asset. As already mentioned, exit planning should start early, with considerable thought being given to structuring and positioning the business to make it attractive to likely buyers, as well as networking and relationship development with these buyers. A lot of preparation should go into the robustness of the management plans, the detail of due diligence, and other reports. Efforts should be made to warm up the market by making potential buyers aware of the upcoming sale several months before the formal process starts. The exit thesis normally forms a key part of the investment approach for any investment contemplated by the private equity firm. GPs need to understand the exit potential of the underlying business to recognize any elements of the proposed investment strategy that may actually detract from value creation. When deciding whether to exit or keep the company in portfolio for a longer period, a private equity firm should consider several strategic factors. Most likely, a successful exit strategy balances the company's need for additional growth capital with the need to provide returns on capital to the fund's LPs. The possibility of obtaining a capital gain depends primarily on the performance of the company in the portfolio. The divestment decision is taken when the investment, thanks to its operating and financial results, allows for a return deemed attractive by the managers. The decision to divest, unless it is forced by the need to liquidate the investment quickly due to maturity of the terms of the fund, occurs at the end of a growth path. It therefore occurs when the three factors of value creation, the growth of operating profitability, the leverage and the potential arbitrage on multiples, allow a level of capital gain considered attractive.